Here is a stacking warning: what to do and not do during the banking crisis. Did you know that SD Bullion is giving away a monster box of 2023 Silver Eagles? Sign up today at sdbullion.com/sweepstakes. Hey everyone, thank you so much for watching Yankee Stacking. I'm going to give you stackers out there a warning over what's going on with the banks and what you should do and not do during this crisis. Now, if you get a lot of value out of the video, please give it a thumbs up, subscribe. If it makes you think and really concerned, share it with others. You know, most financial advisors and common everyday wisdom tells you to put your money in a bank. The banks are responsible, right? They know what they're doing with your money. And of course, the government insures your deposits, so they're safe, right? Well, that's the conventional wisdom, and people put their life savings into banks and credit unions. You know, and I know that credit unions function slightly different than banks. You know, depositors or shareholders and all that, they can vote. But the similarities between a credit union and a bank, I think, outweigh the differences in this regard. So let me tell you the truth here. The entire banking system is a house of cards, a long line of dominoes that just one banking institution can start falling. People are getting really scared, and I'm going to give you some suggestions on what to do with all the turmoil going on about bank deposits, cash, investments, and precious metals. So let me give you two facts that you have to know. First, your cash is not in the bank. The banks don't have to keep any of your money on reserve to meet withdrawals. I mean, that is the result of the monetary blasphemy known as fractional reserve banking, coupled with a moronic move by the U.S. government to eliminate all bank reserve requirements during COVID. And here's the second banking fact that I hope you know, and it may come as a wake-up call to some of you. Your bank deposits are not your money. You don't hold it, you really don't own it. And they can do whatever they want with your money. Like, I don't know, make a stupid investment in long-term treasuries and mortgage-backed securities that triggers a bank run and renders the bank insolvent? Yup. Your bank account holds what amounts to a big, fat IOU. It's a promise from the bank to repay you. A promise. That's it. And technically speaking, you're what's called an unsecured creditor. This is really important, guys. Cash in your hands and cash in a bank deposit are not the same thing. Also, the Federal Deposit Insurance Corporation, the FDIC that we're hearing about in the news all the time, it's giving everyone a massive false sense of security. I mean, you probably all know by now that when a bank fails, the FDIC promises to pay the depositors up to $250,000 out of their deposit insurance fund. You know, make people whole is the term, right? And credit unions are federally insured too by the National Credit Union Administration with the Share Insurance Fund. They also have a similar $250K limit. But let's get real. The FDIC has around $126 billion in reserves. Sounds like a lot. But considering that there are almost 10 trillion in insured deposits throughout the U.S., it's pathetically small, around, 1.5%. And that doesn't even scratch the surface of all the uninsured deposits that banks are literally begging the FDIC to cover. Yeah, almost 200 banks are in the same boat that Silicon Valley Bank was in. And they all want to have their deposits covered, regardless of the amount, for 2 years. Now, SVB had around $210 billion in customer deposits. The Fed, the Treasury, the President have already guaranteed that all of those as well as the deposits at Signature Bank, will be covered in full. That essentially must wipe out the FDIC fund, right? Well, not quite. The central bank stepped in, and they're going to grow their balance sheet again to cover the losses. People, we have another round of quantitative easing going on right now, round 5 to be exact. Bottom line, we're printing more currency to bail out depositors. All of this to say that these are the reasons I've withdrawn my savings and keep it as cash in a secured location as a short-term prep. People, protect your hard-earned wealth. Be the bank. Sound like a broken record because I've been saying be the bank for almost 5 years now. The monetary system is self-destructing at an alarming rate. And when the whole house of cards collapses, you're going to see things like lines outside of bank branches, bank holidays, capital controls, bail-ins, deposit confiscations, and eventually a forced conversion of cash to central bank digital currencies, CBDCs. That is coming, and it's coming rather quickly. So let me tell you what to do and not do. This is my opinion only. I'm not a professional financial advisor, so you do you. But this is what I think. Number one, if you haven't already, remove any savings from your bank as soon as possible and only leave what you need for weekly and monthly transactions. If you've got, a big sale of like your house or something huge and you're going to be moving it soon to something else, that I can understand why you want to leave that in the bank for the short term. But get the savings that is just sitting there in the bank. Get it out, preferably in 20s as a short-term cash liquidity prep. Cash, guys, will be king for weeks and months if the system fails. Yes, it will be continually debased by the powers that be, but you're going to need it in the short term. Number 2, no surprise here, buy physical silver and gold. Guys, this is real money. It doesn't have any counterparty risk. That's probably an obvious thing, especially since I'm talking to a bunch of stackers here. But if you've been sitting on the sidelines, you really need to be buying silver and gold. But number 3, don't panic stack by going all in on physical precious metals. You shouldn't buy massive amounts of silver and gold all at once when the spot price takes off. There is bound to be some pullbacks at some point, and you should stick with a dollar cost averaging approach. Again, the time to buy a large amount of silver and gold is when the price is depressed, when precious metals are largely ignored by the masses. That's when you're really being a contrarian and buying at the right time. So dollar cost average. Don't go completely hog wild with precious metals. Number 4, don't panic by taking a massive withdrawal penalty emptying out your 401k. I just got an email a little bit ago from one of my members asking if she should just empty out her 401k, take the penalty. No, it's not worth it. Move some or a lot of what you've invested into cash reserves if you can, but leave it in there. If you have an old 401k from a past employer, you can consider rolling it over to a self-directed IRA and invest in other asset classes. I have a link in the description of this video for the one that I use. Number 5, the last one, do resist the introduction of a central bank digital currency. I'll be dropping a new video on CBDCs soon, and I have a very interesting tool to help wage war against CBDCs. I'm going to share it with you then. Well, I hope you like this video. Please hit the thumbs up button. Tell me what you think in the comments below. And as always, I hope your day is A-OK.